Hi, this is Lara at Elliott Wave Stock Market with your daily analysis for Wednesday the 10th, recording the video 8:35 p.m. Eastern Standard Time. For Wednesday, I was expecting a wee bit of sideways movement to probably be followed by some more downward movement, but that's absolutely not what happened. Price moved strongly higher, volume slightly higher than the prior day for a doji. We saw a strong upward day which moved above the invalidation point on the alternate hourly chart, which I had slightly favoured. Let's have a look at the wave count. I'm changing the main wave count. We should always assume that the trend remains the same until proven otherwise. My main wave count for that reason will be bullish until we have confirmation that the S&P is in a bear market. The main wave count has a new target at 2880. Primary 3 will reach 2.618, the length of primary wave 1. I have quite a bit of confidence that this diagonal structure really should be over here. We just don't normally see diagonals with big breaches of their trend lines. So I expect with the diagonal over here that this downward movement may have been a correction to follow it. If the diagonal structure is over here, then for a bullish wave count, we have to move the whole of the diagonal down 1 degree and see it as a leading diagonal for a first wave, and see minor wave 5 as incomplete. So minor 5 still begins here, and now it has a first wave leading contracting diagonal, and now probably a complete second wave correction. Second waves following first waves and as leading diagonals are usually very deep indeed. This one probably won't be able to do that though, because there's really strong support offered by this bull market trend line, which goes back to November 2011. It's reasonably shallow, it's repeatedly tested, it's highly technically significant. While price has not closed 3% or more of market value, which is at 2037 or below, my main wave count will remain bullish. I will expect that the S&P remains in a bull market. Minute wave 2 may not move beyond the start of 1 below 1820.66. Let's have a look at this idea at the hourly chart and see how the zigzag may have unfolded, where the diagonal structure ends up here. We may have a 5 triangle for the 3, 5. We may have a complete zigzag down here. If we see a triangle for this sideways movement here, it does have a reasonable fit. The only problem is within the B wave of the triangle. This is a running contracting triangle. B moves slightly beyond the start of A, that's okay. All the rules for the triangle are met. The problem is this downward movement does not look at all like a 3. I'm reasonably confident that this is actually a 5, not a 3. But to see a triangle here, this has to be seen as a 3. There's no Fibonacci ratio here between minuet waves A and C. That's okay. The S&P doesn't usually exhibit ratios between its A and C waves within zigzags. If the second wave correction is over here, and I'm expecting it would be much more likely to be over because of the support from that bull market trend line, then a third wave may have begun here at 2580. The third wave will reach 1.618, the length of the first wave, leading contracting diagonal. Within the third wave, we may have the first 5 up complete here. We may be looking for a second wave correction to begin down tomorrow. It can't move beyond the start of 1, below 2072.14. In the very short term, if we get a new low below that point, then this wave count, this alternate, will slightly increase in probability, but it absolutely must have confirmation with a close at 2037 or below before we can have any real confidence in it. That's essential. If we move the degree of labelling of the diagonal all back up 1 degree, now it's possible that the whole movement up to and including primary degree could be over here. This is a substantial trend change. We absolutely must wait for some confirmation before having any confidence whatsoever in this idea. The bull wave count, and it's still bullish because at cycle degree it sees a 5th wave unfolding upward, is going to require a big primary degree 4th wave correction at some stage to turn up along the way. It may have begun. Primary wave 2 lasted 12 weeks. It was a relatively deep, quick zigzag, just one short of a Fibonacci 13 weeks. So, given the guideline of alternation, primary wave 4 may be expected to be a flat combination or triangle, and they are usually more time-consuming structures than quick zigzags, so I'd expect it to last maybe a Fibonacci 21 weeks. It's likely to take price down to within the territory of the fourth wave of one lesser degree. Intermediate wave 4 has its price territory from 1730 to 1647, so this is a substantial downward movement. It's actually quite bearish despite the label of a bull wave count. It's bullish at cycle degree, but it's bearish at primary degree. In order to have any confidence whatsoever in a trend change at cycle at primary degree, we must have some confirmation. At the hourly chart level, if primary 3 is over here, we don't even have a clear 5 down. At the hourly chart level, we have absolutely no confirmation of this idea. There are a lot of very bearish indicators, but we don't have any confirmation. If we're looking at a new primary degree trend, it has to start with a 5 down at least at the hourly chart level and also at the daily chart level. So we have 1, 2, and 3 is incomplete. We may have 1, a combination for 2, 3, and a zigzag for 4. So there's alternation in structure, although there's not enough alternation in depth between 2 and 4. We need the fifth wave down. At 2035, minute wave 3 would reach 2.618, the length of minute 1. Draw this channel from 2 to 4, place a copy on 3. The fifth wave may find support around the lower edge of that channel. If we see any more upward movement, this fourth wave may not move into its counterpart first wave price territory above 2112.86. To the upside, a new high above this invalidation point and invalidation of this hourly wave count would provide quite a lot of confidence now in the bull wave count. I'm struggling to see how I could rework this wave count to see a new downward trend unfolding. I am really struggling to see how I can have a higher invalidation point, and with no clear 5 down at the hourly chart level, this idea of a big trend change at primary degree should be approached with extreme caution. The bear wave count sees the possibility of the early stages of a huge market crash, but again we have absolutely no confirmation of this idea. On this chart, I'll draw your attention to on-balance volume. This is a trend line that goes back to October 2014. On-balance volume has breached that trend line to the downside. Because that trend line is so long held, that's actually a reasonably strong bearish indicator. But an indicator is not the same as confirmation. From a regular technical analysis perspective, this upward day is finding resistance around about this long-held bull market trend line. The next line of resistance may be this short-term little downward sloping blue trend line. If that's breached, if price moves above this line, and if price is above both of the double bull market trend lines, once we get that, then I would expect new all-time highs. But for now, at this stage, we do actually have a trend indicated by ADX. ADX is above 20, it's at 24.02 for Tuesday's session. And the negative DX line is comfortably above the positive, so there is a clear trend indicated, but the trend is down, not up. This bounce would be expected to be a reaction against the trend, and that's why I'm drawing this short-term trend line to provide resistance for any more upward movement for the short term. There are quite a few other bearish indicators apart from ADX. We have a rise in prices to new all-time high here, but it was not supported by volume. On balance, volume is trending lower, so this rise in price is suspicious. We also have a breach of the lower of the double aqua trend lines, but again, we still need to see a close 3% or more of market value below the lower of those lines before we can use it the way it's supposed to be used, and it indicates a change from bull to bear. There's quadruple negative divergence between MACD and price at the weekly chart level. There's double negative divergence between MACD and price at the daily chart level. And if you take a look at RSI on a monthly chart, you'll notice that back in March 2013, RSI moved above 70 into overbought territory. And since October 2014, we've seen some pretty good divergence. As price moved higher, RSI is moving lower. Now, the last time RSI managed to remain above 70 for a while and then showed some divergence with price was October 2007, and we all know what happened after that. On balance, volume has breached that trend line I showed you on the bear wave count, and the Nasdaq and transportation indexes have failed to make new all-time highs, while the S&P and industrials did. So the S&P and industrials tell us that there's still a bull market in place, but that's not confirmed by Nasdaq and transportation indexes. Now, that does not mean a bear market is in play. It just means a bull market hasn't been confirmed. That's all for me today with your S&P analysis, and I hope that all of our members are having a fabulous day.